Welcome to StockMarketFunding.com, part number 2, 10-year bear market history in the NASDAQ comp with the greatest of exuberant bubbles that always fail. They failed here, and we are going to go up again. And moving forward, in 2011, 12, 13, 14, and 15, we will have the similar failures. We will keep this up on our website for many years to come, so that the people who have the privilege or find this very videotape of the 10-year bear market history with two extreme bubbles, tech bubble here, housing bubble, subprime bubble, commercial real estate bubble here. And every time in America we come in and we stimulate the economy, but guess what? We're stimulating it now with irrational exuberance. Again, people, one thing about being an SMF Pro trader here, whether it's 1 year or 10 years, we have people that have been with us for a number of years. We have called perfectly the tops, how the bottoms would work, how expansions are based on economic indicators, how they fail, what the history was, when to be long off the bottom like we were. Now we're going to be going in as we move between March 1 of 210 to end of calendar year with election year, is that we will crumble again. I have not known any time in history that these exuberant, irrational stimuluses have ever held. If they did hold, then this one here was an expansion. We would have never came back down here. That one didn't hold. This one surely didn't hold. We would never have these collapses if they worked. Okay? And one thing about StockMarketFunding.com, when you're in the school, is that not only do we take a look at the 10-year bear market history, is that we take the trades this way, we take the trades down. What I will be doing is that there will be another period of time that people will get extremely wealthy on another move down, just like we did here and like we did here. Basically, you had two catastrophic systemic risk bubbles in a 7-year period. And as we move forward in this world that we live in today, when it comes to U.S. capital markets and worldwide emerging markets, is that once the exuberance is done at taxpayers' expense. Now the taxpayer from this move down is in much worse than any other time in bubbles, in my view. The taxpayer is being drained. Healthcare is one that was forward-looking. The TARP, there are many things that has happened to you in your life, and what you're experiencing in your life today is why this is quite different than any other time. And as we move forward at the end of the year, the Bush tax cuts come off in 2011. January's not that far away, huh? And guess what? Every state in the union is much worse off in their own personal state fiscal budgets and income structures than I have seen in my 30 years of actually being a trader. And when we teach our students and our investors, we teach them about economics because we're really good at it. And we also have an economic database, a mathematical ratio base. We also have a stock fundamentals. So right now, like everything, you stimulate and you stimulate and you keep stimulating and you keep stimulating all the way up, and look what happens. And then you stimulate, stimulate, and stimulate, oh boy, look what happens. This is going to be a 10-year anniversary bear market cycle anniversary for the NASDAQ. Technology here, technology here. Technology has been a big player in this move here. So has retail and other things. What I am happy to tell you, that if you're invested, you have an IRA or 401k. I did a video about the next gimmick. That's where the people that have those 401k contribution plans, guess what? They're going to get conveniently over into the Treasury Department with that government. I would go find that tape that I did on that. So this is the bear market history. This is what all the pundits and the financial people in the world see. If I come right up there to this trend line at 2,500, that makes this and all the talk, oh, we got this great V shape. So here's the V shape right here. That trend line down right up to here. We haven't gotten up there yet, but they're going to try to keep pushing it to the maximum limit. They pushed it to the maximum here. They pushed it to the maximum here. And they will push it to the maximum again. And when all the people get in, all the mutual fund managers, all of institutional managers, all the buying holders getting up at the top, bam. When everyone got in here up at the top, they were all in. Nobody, it took a number of years to get the consumer or retail trader or investor to even want to come back in the market. They didn't even want to come back. And like always, the bigger part of the move, before that they started to put their trust back in the financial services industry, it was really back over in this period of time. And guess what? As soon as they got them all in, one of the biggest bear markets since the Great Depression, 1929, went straight down. Guess what? They're getting them all back in again. Except this time is different. Most of the retail public and Main Street and Wall Street have a huge disconnect, because they do. Main Street doesn't see eye to eye with the banking system, nor does it see eye to eye with the system in general. And so basically, I'm going to pause the tape for just 1 second. We're going to go to segment number 3 because it's a 10-year anniversary, and I'm going to start part 3 in your next tape.